Good day, fellow investors. EdenRed and Pluxee in that initial stock analysis. EdenRed stock P ratio 10, the stock has crashed, and now the question is whether it is interesting here. On my research platform I have a nice suggestion thread, and there are always these great ideas where I can then go research deeper, and often I find something to follow and cover. So Stefan here asks about EdenRed, P ratio of 10, dividend yield of 5%, 10% possible projected growth. And when you find something like this, it is bound to destroy my Sunday as I'll spend researching it. Nevertheless, the business model is a robust, scalable business model focused on earmarked payments. It is where employees spend their employee benefits mostly on food. Globally, everything looks good from a business perspective, but there is some issues, some regulatory caps in Italy, legal investigation, and France proposed reforms. Also, they made an acquisition in Brazil, but if they can scale their network effects, it's a benefit also for the people using it because they can get discounts. It's a benefit for the participants, the restaurants, and therefore it is a very interesting business model. They are paying a dividend, announcing a new buyback of 600 million, which is more than 10% of the market capitalization. With the dividend, that's a double-digit yield. The risks, the debt is significant. We'll discuss also later competitor Pluxee, which is a new spin from Sodexo that has a net positive cash position. When we look at margins, gross margins have been improving, total revenues have been growing, therefore they are not sacrificing anything from the business to grow. Earnings growth follows revenue growth, which is always a positive, so earnings are even growing perhaps faster than revenue. Cash acquisitions are significant, so they are scaling and growing through that cash acquisitions. That can be good, but also bad if good acquisitions can't be scaled and what's left is high debt. Good cash flow, growing cash flows, mostly spent on buybacks and dividends. Keep in mind the risk is the debt. There is negative equity, but that is still from the spin, again another spin here in 2008, and the explanation is that Accor Group just dumped intangibles that were there, revalued, and therefore you have now a negative, let's say, equity. Plus that was 2009 and all kind of things happened, but since then it has been stable. This is the company that spun them off. The core business model is prepaid solutions for corporations where they can have digital cards and mobile apps to buy things around as employee benefits. They know the laws. So employee benefits 60% of revenue, mobility fleet solutions, complementary solutions, global 45 countries, thus diversified, digitally transforming now, highlights high cash flow visibility, depends on regulation, which can be plus and negative, capital light model. So very interesting business, and we see also Pluxee, a recent spin from Sodexo, similar business, but also negative market sentiment. Pure play employee benefits, corporate payments, so the same as EdenRed. There is another one competitive up group, but it is not listed. Product offerings, comparables, all looks okay. I don't see much of advantage. One has no debt, but still needs to improve post-spins. Highest in the sector margins, so Pluxee might reach those margins. That might be a good thing. There is a competitive edge as it's not really easy to enter the segment. Thanks to ChatGPT for helping me work on this. So there are the moats. The summaries, what is the moat, what is vulnerable, governments, cost, taxes, digital wallets, fintech, investor sentiment, shocks based on expectations. But still diversified, still mostly on Europe for EdenRed, but okay. If we are looking here 2 million users in Germany, totally 60 million users, expanding globally, Taiwan. They have debt, significant debt. They just made an acquisition, I think. So that is again impacting their returning to shareholders, and with the high cash flows, they can maintain that positions. Their target is EBITDA 10% growth. That's the growth estimations that Stefan also mentioned. France might not be that important as it's just a minor part of the revenue. Let's discuss the business, the strategy, and then also the investing situation. So 60 million users, 41 billion business volume, 2 million merchants, all connected, eat, care, move, pay for those benefits. As they are expanding, scaling with 60 million consumers, that's always interesting. Global platform, not yet in the US. I have to see who is in the US. They plan to grow to 5 billion total revenue. That's the 10% growth there. If they can do it with good cash flows that we have seen have been scaling in line with growth, this could be a very, very interesting investment. Operating still in underpenetrated markets, and if they can just seize the opportunities, continue to grow, then it might be very interesting, especially now, because a year ago, a year and something, 2 years ago, all the good that I had mentioned now has been priced in. Now, at a third of that price, now it gets interesting, because dividend plus buyback, that's already 11% yield. If I add 5% growth, that's already 15% yield. Okay, but why then is the stock down? Well, we have already mentioned all those declines, but if there is more job losses to AI, new ideas here, that can also be a risk. A recession is always a risk. More regulation is always a risk. On EdenRed, I just started this. I'm happy to share here, but November 4, there is a Capital Markets Day, and that's something I plan to follow and then update on my research platform. The second company I want to discuss is Pluxee, a recent spin from Sodexo, but also already lost 50%, which then makes it interesting. They are also growing like EdenRed. They have significant client acquisitions, M&A, expanding across regions. So again, Europe, Latin America, maybe the business is not so famous in the US. They have very good finances. They have a net positive cash position. Gross margins are improving, and if they can improve, still that will be significant also for the company net earnings if they can reach the net margin. EdenRed has income statement, everything looks stable, a bit more expensive, but if they can improve the margins, the P ratio might again return to 10. Then if they can start increasing the dividend, as they are still post-spin-off companies, have been repaying a little bit of the debt there, but still with low interest rates, doesn't matter, especially with their high cash position, positive cash position. They have a nice float there where they gain interest income. So again, underpenetrated markets, same story there. If they can grow, if they can scale over the next decade, it might be very interesting. Now, I have bought companies for my diversified portfolio mid position, which means I still have to watch. There is still risk, recession, etc. So for now, they are already at 10 to 15% returns based on valuation. The risks are my knowledge. I have to learn more about the sector. The positives are the growth, interesting sector, potential also takeover candidates. That's why perhaps those businesses were spun off from companies like Sodexo, which is again something interesting, a very stable dividend payer that we'll discuss likely on Monday. So I hope you enjoyed this video. You can check my research platform in the description below for even better businesses than this. If you like what you see, subscribe, and I'll see you in the next video.